Are Indian startups finally seeing green shoots of recovery? That's the question we are asking after a string of valuation markdowns in the Indian startup ecosystem from the start of the year. US-based investor Fidelity has increased the face value of its investment in e-commerce firm Meesho by 14.3% to $43.24 million as of July, bringing the company's valuation to around $5 billion. Just a few days before this, US headquartered asset management firm Barnik Capital also marked the value of its stake in food delivery platform Swiggy up from 33.9% from 31st of March to $8.54 billion. Does this mean that startups in India are recovering? There is better valuations and more companies are looking back to invest in Indian startups. To discuss that, we have Barnik Chitran Maitra joining us on the broadcast. Also, my colleague Krishna Kumar joining us here in the News9 studio. Let me quickly get in Barnik first. Barnik, good afternoon. Thank you so much for taking time out. Is the worst over for Indian startups from what we are looking at the moment? There seems to be more interest towards better investments that have not come in by the way of a very prolonged funding winter.
Yeah, so I think in short, I think the worst may not still be over. So let's look at the facts of some of these valuation markups, right? Fidelity has marked Meesho back to the level it was actually before its own valuation markdown a quarter back, right? So pretty much Meesho is back at where they were with Fidelity nearly 6 months back. Similarly, Swiggy's markup is pretty close to what Invesco, another investor, values them, which was still at around 50% below their peak valuation. Now, it's interesting to note that a lot of these markups have been driven by pure profitability. So Meesho is now the only true horizontal e-commerce platform which is PAT positive. Swiggy has also declared profitability on its food delivery business and has cut down its burn from nearly $50 million to under $20 million. So if you're in the camp where you're cutting your burn and you're getting to profitability, maybe the startup winter is turning to spring. But if you're still burning a lot of capital and don't have a path to profitability, it's going to continue to be a long, hard funding winter for you if you're in that camp of cash burn.
All right. And the game of unicorn and soonicorn and the fact that we keep celebrating, India got its first unicorn very late in September of 2023 by the way of Zepto. Are there more unicorns in the pipeline? Is that still a markup that we should be celebrating? Is it still significant, or have we sort of shifted the conversation? There's been a structural shift to beyond valuation to what you're bringing to the table, the value that you're adding for your customers.
Yeah, I think there have been two funding celebrations recently. One is the Zepto funding and the other is the Perfios funding. I think we should move away as an ecosystem from celebrating unicorns but celebrating startups which get profitability at scale, right? I think that to me is the more important milestone. Even in more mature startup markets like the US, startups are really celebrated when they go public, which you can only go if you're profitable. So I think we are now a mature ecosystem. We can't claim to be an emerging startup ecosystem anymore. We should celebrate successful, profitable public sector companies or public startups who managed to go public, and not just celebrate startups who've hit some valuation milestones, which we've now seen are very, very volatile, and you can get marked down up to 60 to 80%, as has happened with some of the biggest players in the ecosystem.
Right. Krishna, interesting. There has to be a shift. I think Barnik is essentially referring to a shift that was long time coming. It essentially boils down to your business model and what you have to offer to your customers. It's no more about a markup or a markdown in valuation. It's about the actual business, how that business is doing. Perhaps that's one of the lessons that we have drawn from the prolonged funding winter.
Definitely. And if you're talking about the markups per se, the month of May this year was the month in which literally every single big startup in India got marked down its valuation. Ola got a knockdown on its valuation, Byju's obviously because of all its troubles, and tons of others in the month of May. But what we did witness in the month of August, 3 months down the line, was a series of markups, and as Barnik was talking about, these markups sort of bringing those knocked down startups to their original valuations. But they were also accompanied by Shweta cost-cutting measures by literally every single startup which has seen a markup. You've seen Swiggy slash jobs. You've seen the volume of business and revenues grow up, in the January to August period. So there is, I would say, a sense of confidence. And I want to check this with Barnik as well. Barnik, if I were to ask you, you've seen these startups cut costs, get more serious about profitability. At the same time, when the overall confidence in the Indian economy, the Indian market remains high, do you think it's a combination of these factors which are sort of pointing to a turnaround in things for startups, be it in terms of valuation markups or in terms of availability of funding?
No, I think, to be fair, early stage funding has been reasonably robust already for a couple of quarters, right? So the funding winter has hit companies hardest who've actually raised several $100 million and have no path to profitability. So I think the good news for the ecosystem is that profit is no longer a dirty word. I think people are focusing on it and building sustainable companies. I personally believe that this funding winter is going to teach founders to be far more frugal on spending and building far more scalable models. So while I think it is cautiously optimistic to assume that the worst is behind several startups, I think we will still see a few more quarters of spectacular markdowns, maybe some startups going bust, but backed by some startups which are doing better, raising capital and marking up. One big metric I look for personally is public listing. If you've looked at the news over the past 3-4 quarters, several startups have claimed that they are in plans to go public. Actually, no one has really gone public. So the next time we actually see a few startups actually go public, that's when we know that the worst is actually behind us. And I'm keenly observing few startups who actually not only announce plans, but actually go the full distance and go public.
Right, and going public, all the more important, Barnik, because a lot of numbers and figures that come from these startups which are not public, we don't know how much and how far we can trust them as far as profitability is concerned. Specifically with Byju's, there's been a question mark on what the financials of the company are because they've been unaudited for a while. Given the opaque structure around which profitability is reported, how do you actually believe these numbers?
So listen, I think the best sunshine is the best disinfectant, and in this environment or in this ecosystem, public markets is the sunshine which actually shines on startups. So I think it's very hard to believe any numbers because I don't think the ecosystem has covered itself with glory when it comes to corporate governance on meeting ethics. So for me, I think any numbers we see from private markets, we have to not only take with a grain of salt, but with a bucket of salt. I would far more trust numbers of publicly listed companies which have stricter disclosure norms, which have regulators breathing down their neck. And that's where we see real numbers. Everything else which gets reported either on accounts which have been unaudited or claims which people make when they raise funding, I would take very, very, I would say cautiously and only believe numbers of companies who've gone public.
Fair enough, Barnik, making it sound like data from China when it comes to startups reporting their profitability numbers. But the one thing I want to ask you is that one very clear thing that emerges, especially from Byju's and other things that we've witnessed in the startup ecosystem, is that high cash burn business models are certainly under stress. There's a lot of questions surrounding it, be it in terms of the initial investment and the continuous rounds of investment required to keep those businesses running. So in that sense, does all this churn mean that high cash burn business models go out of fashion and we're looking at businesses with lower cash burn?
So I think structurally, I think investors have now very clearly made the distinction between businesses which cash burn versus businesses which should not be, right? So if you're building a business model disruption where you're trying to create a new business model, I think the expectation from investors is that you get to unit economics profitable within a couple of years and not wait for 6-7 years. I think the only leeway will be given for companies who are building deep and fundamental technology, where I think there will be far more patience for longer cash burns. So while there will continue to be patience for longer periods of cash burns, but I think the scale of cash burns and the leeway the whole ecosystem had in terms of burning hundreds of millions of dollars is likely not going to continue for the next few quarters. That said, there may be yet another round of crazy valuation, crazy funding. That may be around the corner when the Fed starts again reducing its rates. But again, for now, it's very clear that cash burn business models are not getting funded. You can burn, but you cannot burn a lot. I think you have to be far more careful about burning. The days of sponsoring World Cups and the Indian cricket team, I think, are behind a lot of startups. I think that's not going to get encouraged anymore by startups. And some of these excesses being coming down is the right thing for the ecosystem. I think the ecosystem has to demonstrate that it builds responsible companies which are sustainable and scalable companies and which can be taken public in a matter of years. To be fair, even today, and again, I may be the only detractor in the full ecosystem, we are still yet to see the super profitable publicly listed startup, right? Unlike we don't see any Googles, we don't see any Facebooks.
Okay.
So that's
hold that thought, Barnik. That's what I want to ask. In a low profitability environment, do publicly listed companies have a better chance at surviving and, of course, prospering? Because at the end of the day, they are judged quarter to quarter.
So if you are profitable and if you have a business model which scales sustainably, being public is not a bad thing. You should understand why founders and investors love private capital, because it reduces the amount of scrutiny. It does not put them on a quarter by quarter treadmill, right? Now, the downside of that is effectively private capital can go away. As we've seen, you can be subject to severe volatility with valuation markdowns. I think the other path is to go public, but if you go public, you have to be damn sure of your business model, the fact that it is not only profitable, but also scaling every quarter. I think founders who are willing to explore public markets, and I'm increasingly seeing a lot of founders who are exploring ideas like SME exchange, the BSE SME exchange, to list primary capital from the public market as an IPO and not use venture capital. You have to be ready to face the scrutiny and be on a treadmill where the speed of the treadmill is increasing every quarter, right? So if you're ready to face that music, I think the public markets is not a bad draw. But remember, a lot of companies don't go that route because they're structurally either not profitable or not ready to be scrutinized at the level you will be when you go to public markets.
All right.
All right, Barnik, thank you so much for taking time out this afternoon. Thank you for speaking to News9.
Thank you. Thanks a lot, Shweta. Thanks, Krishna. Take care.
See you. Bye-bye.